Our topic today is, as you mentioned just now, is a panel discussion. We have three distinguished speakers here with experience almost 100 years. Among them, I calculated almost is 99 years, short of 1 year. And plus my experience, we have another 40 years experience people on the stage. So be assured you are in a good hand, okay? Just to be fair to these people, let me introduce, I know it's in the brochure of the experience. Just let me highlight, George has got 37 years experience in insurance. He is now with Willis Towers, Perrin, as you know, and is very much involved in captive management. Datuk Lim, chairman of MARIM, and also chief risk officer of TMB Tenaga Nasional. And Tony Egerton used to be with Lloyd's Singapore, now very much in Labuan, a Labuan player, has been around, especially in Japan, to promote a captive in Labuan. The rule of the game is very simple. I pose some question, basic question, and I need a practical answer with all the examples. Okay, we have gone through the principle around on the sky just now with the review result of the questionnaire posed by captive review, but now we are on the practical. We're coming down to practical level, and I'm sure the three of them are very practical men. And I got a very practical question with all the answers on that. Let me start with George. I think, George, we have among the audience those people from various industries, oil and gas, power, turbine, plantation, all those things. And I'm sure in their mind, they would like to know what kind of structures or what kind of industry that would suit the kind of phases that we mentioned in our topic here, that is captive PCC, pure single association, ran a captive PCC, but I don't know what the ICC, if someone can give me the answer for that, I give this present ICC, maybe the expert can do that. Again, George, for a start, can you explain to the audience, you know, I'm sure they are from various companies, they want to know what kind of structure that suit their operations, their reinsurance structure, so that they can go back to the board and sell the ideas of setting up captive. Josh? I'll be standing here, but I'm more comfortable standing here rather than sitting down. Josh, go ahead, you don't mind, yeah.
Okay, thanks. I'm quite comfortable sitting down, not necessarily up here, but sitting down. I think the first issue for any company looking at captive as a potential route forward is to define exactly what it is you're looking to achieve from applying captive techniques. We tend to talk of captives in terms of captive insurance companies, what in Labuan we call a pure captive. So you as a non-insurance company would incorporate a licensed insurance company in Labuan under the specific regulations established to govern captives. Those are not light regulations. They're regulations appropriate to a captive, which is established to assist the parent group in managing and financing their risk. It's not competing with the commercial insurance market in offering services and risk protection to unrelated entities. So for any company, the first stage is the value that you're looking to achieve from incorporating a captive approach within your risk finance. So pure captive is the most common form that we see. Companies from every industry you can imagine and huge number of countries, not quite as many as you can imagine, and of all sizes have established pure captives. Having your own captive as an incorporated subsidiary gives you maximum control over its operation. It reports back into the parent company as a subsidiary. And it's the most formal mechanism possibly. That also makes it quite a difficult sell internally, and we talked earlier about the key issue, or a key issue being selling the idea of incorporating a captive to your C-suite and your board. You have to establish a subsidiary, it's for insurance, it may be offshore, a number of obstacles that you have to go through in getting the captive in place. You've got the option of, rather than setting up your own captive, of renting the use of a cell within a facility owned by a service provider. Various names for them, but usually protected cell company or rent a captive. Within that structure, a company such as ourselves establishes a protected cell company. The company itself contracts for insurance and reinsurance on behalf of clients, but each client's business is held in a legally segregated, distinct cell within the company. There's no mixing of risk. So very different from a commercial insurance company. Advantage of doing that, there's a general theory that small companies might suit PCC, large companies should do own captive. It's not quite that simple. PCCs are not necessarily captive because you have to pay fees to rent the use of the PCC. They are regulated. The PCC itself is regulated by LFSA, and the cells are regulated. So it's not a way to get around regulation. It does allow you to put a captive element into your program quite quickly because you don't have to go through the whole process of incorporating and capitalizing a captive. And it avoids the need to go to your board looking for approval to incorporate and capitalize a subsidiary. So it can be a way around that initial issue of getting C-suite support at the parent. Downsides, though, you have to fully secure the risk held within the cell. Under the regulation, the cell has to have assets and reinsurance equivalent to the total aggregate limit of risk that it assumes. Whereas within a captive that you own, as an insurance company, it has to be prudently secured against the risk, including credit risk. There was an excellent question earlier about captives and credit risk. But it doesn't have to be dollar for dollar secured in the way that it does in a PCC. I'm taking up most of the hour here, aren't I?
Okay, Josh, just hold back for a while because I know it's very technical stuff. I think on purpose. Because he's an advisor. He wants you to come to him to understand further. I don't have a card for that. Okay, let me go into the very easy part of it. One of the findings, I always refer to the findings because that is basis for our discussion. Now the finding of the captive review is that there's no commitment from internet decision maker. I would like to tell you the story. Give me 2 minutes. When Banagara took over the insurance industry from the Treasury, meaning that I was still there, we being swarmed by all GLCs to ask for a license. But unfortunately, at that point of time, Banagara already have established a policy, no more new licenses. And they asked these GLCs to form to group together, form a company. That is Labuan today. Okay, I have experience for both as a regulator, as also manager as Labuan at one time. So meaning that the commitment of pooling, having own insurance company has been there since 1983 in Malaysia. I don't know what's the reason for them to apply for a license, but I'm sure they see there's a value in having a license to capture their own business. And today, Labuan has got 9 GLs shareholders, if I'm not mistaken, or 9 or 10, and most of them are GLCs, except for one, Petronas. Razia is here, who really see the benefit of captive. Okay, so I'm sure there must be a reason why the GLCs has not embarked into the forming a captive. Here I need to experience Dato Lim being the risk manager of Tenaga National. I heard news that they are also thinking of that, to explain, to tell us his side of the story as to why GLC is quite reluctant to face the music of being having a captive, at least in Labuan, to support the Malaysian domestic retention. Datuk, can you explain to us, please?
Thank you, Dato. Good morning, everybody. Okay, I'm Lim from Tenaga National. I always said I am actually not an insurance man. I'm actually 33 years as an engineer. For the last 4 years only, we set up a risk department under the board risk committee. They form a chief risk officer. So I was given a chance to lead that organization, that department. To the chairman, question is why GLC was reluctant. So I would not say reluctant. Just now, I think the survey actually put out all 5-6 reasons. All these 5-6 reasons are very relevant to all the organizations, not only GLC. I think it's relevant to all the organizations. But today, I just want to share my part that's only in Tenaga National. Other GLC, sorry, I'm not quite sure. Okay, we all know everybody in the risk management industry always take the statement, come captive is the extension of risk management. But in the engineering perspective, I would not say it's extension. It actually come along. It cannot be extension, mean right the day one, your risk management very poor. And on top of it, just want to share, how many engineers here, angkat tangan? Hands up, engineers. Okay, we have only 1 or 2. When you go and talk to the engineer risk management, they will chase you out. Risk management, no. That is the insurance people, all these things. We engineers talk about engineering excellence. We engineers talk about redundancy. We don't talk about risk management. But actually, they are the same thing. Risk management is the same as the maintenance regime. So when Tenaga National went to the market, every year, because we are just like Petronas very much bigger than us, our asset, we have to go to the insurance to actually underwrite our asset. Every time we go, all the insurance say, hey, I want to see your risk survey. I want to see this, I want to see that. And every time Tenaga National, we engage the insurance industry, and some of the insurance colleagues here, they have been with us for the last 3 years. Every year we tell them how good we are, how great we are. They still don't believe. Because, this is my opinion, their underwriting pen have to refer back to their technical people, refer back to their principal. They also want to buy their risk assurance. In the event there is a claim, hey, I actually checked the risk survey said that all these things. So this is one of the reasons that many of the GLCs say, are you very difficult? Myself, we just go to the insurance, don't go into the captive. So now, because of talking to the insurer, now we understand. So we better tell the industry, if my risk management, I believe my risk management, I dare to insure my own asset, the only way is go to captive. Send a signal to the industry, say, hey, we are ready to insure our own asset. So for Tenaga National, Chairman's right, we are actually seriously thinking about setting our captive. We are almost at the last mile of this. Hopefully, God willing, by January, I think we will be there together to join you all. Join my colleague here. He has been telling me so much in Singapore, and we actually very believe it. So Tenaga National, hopefully we will be there next year.
Okay, thank you, Dato. It's bad news for insurers.
No. Actually,
thank you very much for sharing.
We are sending a signal that we actually dare to insure ourselves.
Red signal. Dato, thank you very much for sharing. This is what we call practical. Okay, practical, nothing in the sky, no drone, nothing is submarine, or not submarine. So now, of course, I agree with Dato. The captive is just extension of risk management. It's a logical extension, if they know. I hope we can get the benefit of that. Well, Tony, leave it to you. You are expert in Labuan, and just to ask you, from the statistics I see from Labuan annual report, we have 40 captive at the end of 2016, the same number since 5 years ago. But the increase in the premium coming outside of Malaysia or Labuan increased from 29% to 53% in 2016. To see the contribution of the out business is moving very fast here. So, but the concern, my concern as a player also is the stagnation of the number of companies setting up in Labuan. We see the survey just now, a lot of people thinking Labuan is almost 70% of the opinion saying that Labuan is the area where they would like to domicile with all these tax as well as the low cost of doing business. Tony, you've been promoting Labuan almost 3-4 years, even giving conference in Tokyo to attract Japanese players. What do you think? What's your take on this? You know?
Well, thank you, Dato. Good morning, everybody. Perhaps we just need to try harder or do a better job. No, seriously. I think it's understandable that a national project like Labuan will, in its early days, be supported by the national interest. But over time, clearly, if that's all that supports a national project like Labuan, then we're not getting much benefit. So I'm not so concerned with the pure number of captives. I am heartened by this increase in international business flowing through that captive industry. I think that that begins to really show the attractiveness, the effectiveness of the domicile. Clearly, at the early stages, there are supporters here domestically, but ultimately we want it to be a regional success. And rather like the total volume of insurance business now flowing through Labuan, we're finding that more than a half of it's coming from overseas. So the tier 2 access to domestic business is clearly a nice carrot to start with, to provide the catalyst. But over time, we want to develop it as a truly international regional center. It's happening. And that's in the face of, as we all know, and as was covered by the survey, a very soft traditional industry, okay? The ability to buy traditional insurance is almost unprecedented in terms of its cost and availability, all right? So the fact that we are seeing this growth, at least in terms of share, Dato, of international business, I think is very encouraging. So clearly we've got to continue to work hard at it and do a better job, but I think it's encouraging.
Okay, one additional question on that. As you know, been mentioned, and we are very sure that one of the advantages of Labuan is we have this Sharia compliant, especially PICC, a protected cell. You know, how, in your view, what should be the move that to promote the Sharia compliant captive in Labuan?
Okay.
That is a unit for Labuan, you know, have anywhere in other jurisdiction. Yeah.
I'd rather not promote one particular approach to self-insurance. I'd rather that we, as a domicile, provide a full range of options that are effective, useful, and let the customers decide what they want. I think that that's far more appropriate, and I think one of the great success features of Labuan has been its willingness to provide the full range of services, to make sure that it is as relevant as it possibly can be, particularly with some of the changes in the tax and the BEPS initiatives and this kind of thing. Labuan must, but continues to be relevant, and I think that's a key phrase.
Okay, Josh, next question to you. We will listen to Dato Lim about he's jumping from A is a problem, and then from A, the difficulty of having that, very little, and till the end, by end of the year, he might get lessons for that. But in between, I'm sure there's a process of doing that. And maybe the audience, especially the risk manager, would like to know what are the process that we have to go through from feasibility studies, a kind of data that we need to at least influence the board or senior management, either to appoint you as a consultant. But in a nutshell, what are the issues, what are the problems, what kind of data that you must collect first in order to determine, one, to influence your board, second, to determine the structure of your captive? Josh?
Well, firstly, I think it's obvious that you need to appoint me as consultant. That's a given. Secondly, an advert for the first session tomorrow morning when I'm talking about the feasibility study process, so I don't want to tread on my own toes on that one. The key is to understand that, as I said earlier, you're looking at applying captive techniques, which is not necessarily to incorporate a pure captive. You're looking at applying captive techniques to help you improve the way in which you manage and finance risk. And the specific improvements you're looking to make will be specific to your company and the issues that you face. So you need to spend time analyzing your program of insurance, risk transfer, and risk financing, the retained element of risk, which means beginning by looking at the big picture of the risks that your company faces. You then need to look at the resilience of your company to risk. How strong is your company's balance sheet? How liquid is it? How flexible is it to sustain shocks from uninsured losses? And define the level of retention that you are comfortable assuming. And that's a decision that really goes to the board. So you're engaging the board early in the process. I'm getting very nervous because Razia is looking at me and she's been through all this, so just tell me where I get it wrong. But the process is to engage the board in understanding, analysing, defining the risk the group faces, the resilience the group has to risk, and then looking at the appropriateness of the risk transfer arrangements that you have. And you have got the benefit of a perpetually soft insurance market. I think that's the norm. I don't think there's any such thing as a soft market anymore. The market is what it is, and it's been what we would call soft for a very long time. So you've got the great virtue of readily available, relatively cheap risk transfer, but it won't cover all of your risks. Never does. There was a question earlier about how incentivized you are to avoid losses if you're insured. Well, you should still be hugely incentivized. You never recover all of your losses from a claim.
Okay.
The cost of having the claim, reputational issues, time and expense and effort in processing the claim, uncertainties around recovery on the claim. You don't want to have claims. You don't want to have losses. So it's analysing those issues, then looking at where a captive approach, which is really about having a vehicle that formally recognises and issues policies of insurance against risk that you have chosen not to put in the commercial market. If that has value, then you put the captive in place. Then you look at the structure that you want, whether it's a PCC or a pure captive or an ICC or whatever other approach. And part of that process is then looking at the domicile, where you place the captive, to get the best combination of regulatory approach, flexibility in terms of the structure that you can adopt, ability to run the captive to benefit your group.
Okay, now, Tony, you would like to add?
Just 1 second.
Yeah.
I mean, I think one of the challenges for organizations in a soft market is to justify the investment in risk management. We talk about the cheap cost of traditional insurance as being a hurdle to the development of the captive industry. But I think it's much more subtle and complicated than that. I think the problem for organizations like Tenaga is, why would I invest in risk management? Because the industry prices me at the same level as any other organization that doesn't invest in risk management. So I think that's the more sophisticated assessment of where the market is. It isn't just that insurance is cheap, okay? It's the fact that I'm not rewarded for investing and running my risk management strategy appropriately. And I think that in some ways is where the signal from a Tenaga comes from. Okay, I'll retain some risk, but clearly I'll still need to buy a lot of reinsurance. They're not walking away from the traditional market, I'm sure. Yes. But it's more the signaling to the market, look, we really do invest, we really do believe in our risk management, yep, and we are better than the rest, and we're willing to put our money where our mouth is. Yes. And I think that's more of the turning point, if you will.
Very true. Very true.
Yeah, go ahead. We'd like to add.
Okay, very true. What Tony said, that very, very true. We're definitely going to run away from the conventional. And as a utility, we are also regulated by our Energy Commission. So in that regulation, they put a lot of condition that you need to actually provide very good risk management. So definitely we cannot run away from that. That's very true.
I'm sitting down now. I want to take a break, but give you the opportunity to ask question. Okay, I would like to open the floor first before I continue with another 20 questions here. So I would like to open the floor for whoever would like to ask before they forget what they wanted to ask. Okay. Open the floor. Anyone? Yeah, Ray. Ray, go ahead.
With these towers, how many feasibility studies have you made for clients in getting a license for the captive company? Have you prepared many feasibility studies for clients?
Sorry, have
I? A company? How many have you done?
Yeah, I've lost count, I'm afraid.
Ray, can you speak louder? I'm sorry about that. I
how
can't
many
hear you. Yeah.
feasibility studies have you made, and how many have been approved by the?
Yeah, I got it. Yeah. Yeah, I've lost count, to be honest, Ray. It's been many years I've been doing it. Not just in Asia, but in Asia. One of the key elements for me, I've always worked for broker managers, captive consultants and managers that are owned by brokers. And part of the process that our brokers should go through in advising any client on their insurance needs is whether there is a role for a captive technique in that process. I'm not saying that always happens. One of my wishes is that I get involved in just about every renewal that we do, and that doesn't happen. But I do get involved in a lot. Whether that's a formal feasibility study that's a full 2 or 3 month exercise with actuarial analysis, etc., or whether it's giving input to the brokers on the renewal around how a captive might improve the placement, it really comes back to the same point: is a captive approach suitable for this client at this time? So it's a constant process. It's my daily job.
How much do you charge?
Not enough. It depends on the. It depends. I mean, again, this is covered in tomorrow's session, so another advert. But the biggest issue, to be honest, is the commercial consideration. The brokers want me to do it for free, and I often do it for free. But if it's a lengthy and detailed exercise, particularly if it involves a lot of actuarial work, then that requires a specific
There's no
fee.
such thing as free. There's
Sorry?
no such thing as free.
Very true, very true.
Okay, George doesn't want to steal the thunder. It's for you to attend the session tomorrow. Any other question? Yeah, Annie?
Annie from Brighton Management Limited. Okay, my question is, I'm sure over the years, captive have changed their structures or phases, if you like, in adapting to development in the insurance industry, economics and political. Moving forward, what aspects of changes would you foresee taking place given the latest development in the insurance industry, competitions and technology? In particular, as mentioned by the Governor in his keynote address, how fintech, or rather insurtechs, and big data would change the structure or management of captive.
Okay, thank you, Annie. Who would like to take that? Tony?
Annie, thank you. How long do we have?
28 minutes.
Okay, let's look backwards and then try and look forwards. BP was mentioned earlier. 25 years ago, I worked at a Lloyd's broker called Sedgwick, and we placed the reinsurance program for tanker insurance, which was one of the captives for British Petroleum. The company secretary and head of risk at BP, a lady called Judith Hanratty, decided that traditional insurance 25 years ago did not make sense for BP. The total capacity in those days in the energy industry was in the order of $3.5 billion. Actually, I'm not sure it's changed on the energy front much since those days. Okay? $3 billion to BP in those days was not quite an accounting error, but it was unimportant. It was a bump in the road. She said, unless you can deliver to me at least 10 or 15 or 20 billion dollars of capacity, don't waste my time. So the conventional wisdom, and I heard it expressed even this morning, is that BP stopped buying insurance or reinsurance for tanker. Of course, they didn't. They stopped buying operational insurance, which has been the most benign, least volatile class of insurance. They retained that risk in the captive, thank you very much, but they continued to buy construction risk because that has claims. Okay? So, when you have a captive, I think the lesson from that is trade the market. If it's better to retain the risk, retain it, but still buy reinsurance where effectively it's underpriced by the traditional market. We wind the clock forward 20 years, and a small little thing called Deepwater Horizon happens in the Gulf of Mexico. That almost destroyed British Petroleum. How much did it cost? I think about 50, probably 50, 60, maybe more. Okay? It didn't destroy BP, but it meant they had to sell some of their key assets, and they had to totally restructure their balance sheet. But the industry never stepped up and gave them that level of protection, the traditional industry, at a price that made sense to BP. Okay? Now, there are also some other arguments. I mean, we could have a whole conference on BP if they allowed us. There is argument that some of BP's risk management standards were not at the best level in the industry. I don't buy that, but there were those arguments. And that's one of the reasons why they've had not just Deepwater Horizon, but other claims. Okay? It's certainly what the American government has alleged in open court. Okay? So, that's the history. That's just one example, but I think it's very pertinent, and it was mentioned earlier today. Annie, you talk about the future, and the governor is talking about where are we going, particularly with the technology. Steve and his team, who know far more about that, are going to talk about some of the technology issues around blockchain. This is the technology that underpins Bitcoin. Okay, it's called distributed ledger. That's about as much as I know. But what it does mean is, as an industry, it would allow us, if we embraced it, to be much more efficient. But you know, in the insurance and reinsurance industry, we've been promised that technology is going to make us much more efficient for decades. I worked at Lloyd's as well in my career, and we once spent £60 million on an IT system that never saw the light of day. Okay? Some people in this industry, Steve is going to give me a hard time for saying this, think that blockchain is just another example of the IT industry trying to solve all our woes in one go. However, what I do embrace is the ability now within technology to understand data. Okay? We are clearly capturing data on an unprecedented scale, on an hourly basis. You know, there is technology within one programming language I know a little bit about, R, to scrape websites, just to go across the internet and through the code behind websites, scrape data from them on an unprecedented scale. At the other end of the industry, we're uploading data to YouTube and stuff like that at sort of just immense amounts. So the data is there, and at the same time, the technology to process that data and draw insights from that data is also advancing at an unprecedented scale. However, the industry is struggling to keep up with that and trying to work out how much of this risk we can assume, price, model. I don't think captives, pure captives, should be leading that, okay? Because they are ultimately a subsidiary of a corporation whose business is outside risk, outside insurance. So they don't have the innate understanding, and maybe just too much history, some people would say, legacy, but I don't think that they're necessarily equipped to take on all that risk. So I think the future is unclear. It's certainly not orange, but it is going to move fast. It is about data, it is about understanding, and it's about how we use that data. But just beware that I don't think captives, pure captives, particularly for organizations that are relatively new to captives, should be straying into assuming huge amounts of risk and trying to price that. Because you know, I do think there are better parties that may be better at it.
Yeah, okay, Tony.
So thanks. That's the past and the future, Annie.
I'd like to bring you back to the ground, okay? Panel discussion this morning, Tunku Farid talking about medical malpractices by doctors, talking about bar councils. Can you share your experience of PI Club? How do they sort of structure, you know, their program? And Tunku Farid suggested there should be a captive for bar council as well as doctors, you know. Based on the PI Club experience, how do they approach that?
Okay. Well, I mean, medical malpractice and some of these professional liabilities has historically been pooled. But one of the earliest forms of mutualization was, of course, not professional indemnity, PI, but P&I, which is protection and indemnity, which is where 100, 150 years ago, ship owners, initially in the City of London, came together to pool the 1/4 collision liability that traditional marine insurance, hull insurance underwriters were unwilling to provide them with. And this is what started the P&I clubs, okay? The coming to the first group captives, if you will, the first mutuals. Now, these days, the P&I clubs around the world, not just in the City of London, but elsewhere in the world, are one of the biggest and most successful forms of mutual. But they also buy huge amounts of reinsurance. The reinsurance program of the international group of P&I clubs is one of the biggest reinsurance programs in the marine market, okay? So there is a lot of history of parties, both corporations but also individuals, coming together to mutualize risk in that way. There's nothing to stop that happening for lawyers or doctors here in Malaysia. Certainly a lot of experience in other territories, geographies of similar type arrangements. Typically, though, structured by an unwillingness or, for whatever reason, inability to source a traditional solution.
Maybe I can just make a quick comment on the Bar Council scheme. Having spent 3 or 4 years working on the captive project for the Bar Council, the issue there, that the PI cover was and is available in the market, and they were able to obtain good coverage at affordable rates for their membership. But the association and the PI committee of the association wanted to review ways to improve what they were offering, take greater control over that program so that they were not exposed to volatility in the market. And lawyers' PI is a global market. It's volatile and it's exposed to changes in and losses in other areas of the world. Things that the Malaysian Bar Association and PI Committee can't control. So they wanted to take control over that on a long-term basis. So we worked with them and structured a program that involved direct access to reinsurance on a multi-year basis. Hi, Balbir. On a multi-year basis. I'm very nervous because Balbir Singh's sitting over here and he was on the PI committee. And which we established with a great deal of analysis and actuarial work was beneficial to them over the long term. So that program was designed and would work. We then set about the process of gaining approval from the Bar Association itself. And that took 2-3 years, I think. We did get the approval. We were not going to form a captive. We were going to establish a structure within the Bar Association, which was a self-insurance fund, that was in every way, shape and form a captive, but wasn't going to have an insurance license. And the reason for that was to do with the regulatory restrictions around the legal profession, the legal act, and the Bar Association itself. So we were applying a captive technique, but not going to the stage of forming captive. The final stages of approval then required approval from the AG and from various government bodies, and as far as I know, that's never been achieved. But elements of the structure that we put in place, that we designed, are in place, correct, Balbir? So the benefit of that work is being felt by the membership, even though the full structure's not in place, and even though we never actually intended to form a captive. It was applying the technique, not the structure.
It's not a captive, but a self-insurance, you know.
That was where we ended at the point I stopped working on it about 3 years ago.
Tony, anything?
Just one quick addition to what George was saying. I mean, one of the other conventional arguments, which we haven't discussed today, is using a captive to directly access the reinsurance market. A lot of large buyers of insurance feel rather frustrated that they get to deal with local insurance companies who maybe have a limited capacity for some of their highly technical and aggregated risk. And they know that ultimately the major risk goes to the big Swiss and German reinsurers. So they want to talk directly. And clearly, by having a captive, you can be a bigger player at that party. And indeed access some of the kind of reinsurance that I do, for instance, which is these multi-year structured reinsurance deals. That's my commercial. But I mean, this is where the reinsurance industry is going. It's where the growth is in the industry in some of these newer areas. And it is argued, and I think there is some validity to this argument, that by having a captive, you get to talk to the real risk capacity providers directly. Okay, so just bear that in mind, particularly if you buy some big limits or you've got particular needs, that ultimately you know where they go, but you're not at that, you don't have a seat at that table.
Okay, I can't argue with the experts. Can we go down to the floor? Any more question? Yeah, Zuraida. Yeah.
Datuk, ni practical
Yeah.
on the ground.
On the ground.
Captive, would you think that RBC will come to Labuan?
Okay.
If yes, how does this impact to captive especially, where you have to put reserve in your risk charge? Not only that, for the additional UPR where you sit to tier 3.
Yeah.
Practical.
Yeah, practical. It's also in my list of questions, what is impact on RBC on the captive, because most of them is not rated. Tony, I'm sorry, you have to take up it again.
No. I like to talk too much. Thank you for your question. It is very much the case that Labuan is looking at its capital adequacy regimes, and clearly RBC is coming. It's just a fact of life. And indeed, for insurers and reinsurers that understand how to price risk properly, that's to their benefit, okay? Because ultimately, how do you price risk? You should look at the risk capital you have to allocate to that risk, and you should generate a reasonable return on that. And RBC is ultimately the way you should be measured, okay? Surplus to premium ratios is so blunt. It's like in the dark ages, all right? So we have to go there. The industry is going there. Of course, I distinguish between a regulator that allows pure captives to write third-party business. Okay? The minute you start writing third-party business, you should be treated as an insurance company or reinsurance company and regulated in exactly the same way as any others. Okay? But in Labuan, the emphasis is very much on, if you're a captive, you're a captive. Okay? So then you should have a different treatment to a limited extent. Ultimately, you're only accountable to your shareholders. Your shareholders are also your policyholders. Okay, so it's a different relationship. Okay, ultimately, I mean, I could talk for hours on this. I'm an economist. There is some argument that just having a captive upon consolidation, I'm just putting money in one pocket and taking it out of the other pocket. So what's the difference? It's a zero-sum game. Okay, it isn't, but let's just start with that as a hypothesis, okay? But clearly you need to have some kind of regulation, even for a pure captive. You have to have a minimum capital, and I think ultimately you should have some form of RBC if the broader industry is moving to RBC. But it doesn't have to be a fully fledged approach to RBC. I think there is, because you're only writing your parents' business, an ability to be a bit more flexible, and we need to have a separate treatment. So it's coming, okay, to Labuan. It's coming everywhere. So even if a regime at the moment says it's not, they're living in cloud cuckoo land. So let's just embrace it. Let's get on with it. But also let's recognize that a pure captive can have a different treatment.
Right.
Does that answer your question?
Yeah. To sum up, RBC is a new normal. It's going to be the normal. It's a new, but it's going to be normal. It's just like the soft market. It's a new normal. There's no hard and soft market. The rate is that is the rate that was just mentioned just now. So in that relation, maybe Dato, can you chip in? I'm sure at your discussion at your board level, management level, there's always argument that this is a soft market, is a buyer's market. Why should you establish a captive when we get a cheap rate from the market? Can you share with us, Dato, insight into that?
Thank you,
We're
Dato.
talking about practical, yeah?
Yeah, thank you, Dato. As we all know, to set it up, all the company have the same. You need to go through a certain level of approval. Same like us. Same question, some of the board member will ask you. But always we say that first step is, okay, we do a little bit of physics study, and we benchmark. We went to Petronas. We tell good story about Petronas. We tell a few good story. That's second step. Still they say, hey, stock market, why you want to go into it? And this is not the industry that we want to go in. It's a part of our OPEC. Leave it there. But of course, we have to tell. Of course, we brought along the consultant. The consultant to tell, okay, and we tell them the history. You remember that? I think that is. You remember 911? So 911 hit us. The next year, when the market, people all walk away. You just give me a quote 2 times, 3 times, 4 times, they still walk away. So that are the things, you know. Another one is, we say there is a business case. Of course, we say, okay, Petronas make a business case or this thing. Yes, it's not so much, because we are not so big, but that is still a million, not billion. So they like say, no, nothing more than whatever billion don't come to me. But we told them, this is, one of it is plan for the raining day. We hope there won't be any 911. In the event that 911, we are ready there. But on top of it, we think our risk management, internalizing risk management, is up to a certain maturity. We must go to that direction. And then that's one of it. And some of our board members, and you know, all the board members, especially I think my board members, all very clever. There are some from insurance industry, there are some from all these things. When there are those board members in this insurance industry, they will tell their story. They will help us to convince the rest of the board members. So in that perspective, I think we got a very strong support from the board. And on top of it, I think also aligned with our strategic direction. Tenaga Nasional now, we are spreading our wing overseas. I think some of you, we are already now in Turkey, we are in India, we are already in Pakistan, so we also in UK. So we're spreading the wing. So I think if we want to be there, the insurance management or risk management have to be the same, aligned with the company growth. So on that, we are okay with our board. Okay.
Dato, thank you very much. You can be sure that you can be a good advisor, and then a consultant just like Razia after this. You know. Any more questions? Ray, hang on. Can we have a look around? Any more questions before we go to you? Ray, you have a question? Yeah.
At the end of the day, the risk manager must be sure that his reinsurers they are really good, because I've seen some companies, they lose money because their reinsurers also goes bust. The reinsurance companies also collapse. Not all the reinsurance companies are good. So if you choose the wrong reinsurer, you're in trouble,
Tony,
big trouble.
Well, Ray, thank you for your point. I mean, clearly, any contract that any organization enters into has counterparty risk, okay? Be it insurance, be it via the captive and reinsurance, be it any kind of risk. And credit risk is a key component of counterparty risk as opposed to performance, okay? So the willingness and ability to pay of a counterparty has to be measured, assessed, and properly managed. But that's true of any contract that you enter into. Insurance and reinsurance is no different from any other, okay? Historically, to be frank, we haven't been that good at thinking about counterparty risk and managing that. So we've got to get better. I think we've taken, as an industry, we've relied on trust, and perhaps we've relied on trust too much on occasions. And we've got to be 21st century about some of these issues. But as I said, I don't think it's any different to any other counterparty risk that an organization runs.
Okay, Tony, we have 5 minutes, 37 seconds left. Is there any question from the floor? Yeah, can you, yeah, okay, stand up, give your name and company, please.
Good afternoon, my name is Nasser, I am from SNN Capital. My question is based on one of the findings of the survey, which states that roughly about 75% said the biggest hurdle is getting commitment from senior management. But at the same time, 54% think that there's a lack of understanding of the very concept itself. So I'd like the take of the panel. Shouldn't we be putting the horse before the cart rather than the cart before the horse? Get the understanding of the concept firmly in place before we even start to talk about convincing senior management. That's my question.
Yeah, Dato, your experience again.
Okay, first I just qualify. Tenaga Nasional, we have not yet a captive company. We are working very closely on that. I would actually agree with you. It's actually both sides. First is we as a risk manager, we have to understand first. So that's why you need to go to talk to those already in the market. Understand this first. When you understand it, you yourself is convinced. Then you actually put your argument to the board. Don't underestimate them. They actually already industry. They also understand this. It's only need to get two parties to tango. So when we put out a very good a case study, a business plan, because risk management is protect and create values. We are actually follow this principle. We want to protect and create value for the company. And if we understand, part of it is the captive insurance that can protect and create value. So you put out the case, and then when you put out the case towards whatever approving authority, and they actually understand it. So whether the decision maker, the decision maker is, do you have a paper, a proposal to put forward? So that's why I say I will believe both parties also play the important role.
Okay, you like to add?
Yes, if I may. There's clearly an educational issue, but I don't think that's insurmountable at all. I mean, as Datuk says, you know, most board members, hopefully all board members, are clearly capable of understanding the concept. I think it's more of a cultural issue, generally. In certain organizations, insurance spend is seen as an operational cost, okay? I'll give you the experience of my golf club. Sorry about this, everybody. Some of you who know me know I like golf, okay? So, and some people in the golf club know I know a bit about insurance. So they said, Tony, the insurance is up. Come and talk to the head of finance and talk to us about what we should do. So I said, well, what do you normally do? Well, we say we normally go to 3 or 4 brokers, and they go and talk to some insurers, and they give us a quote. I said, what? What do they quote? Well, what we had last year. And as long as the price goes down, and, you know, we're clearly making progress, yes? Operational cost, yes? Nobody's thinking about whether that insurance program is at all relevant. By the way, we just built a new clubhouse for 60 million Singapore dollars. So we probably needed a slightly different insurance policy, okay? So we've got to think about this as creating value through risk management, not minimizing our insurance spend. I can tell you all how to reduce your insurance spend. Anybody want to know? Don't buy any. It's really, really easy. You know, that's what Judith did, maybe. Or maybe she took a more enlightened view. But, you know, got to buy fit for purpose. And we've got to make sure it's part of creating value through risk management. And considering whether or not a captive or a protected cell captive or some other form of retention vehicle is appropriate for you is part of what you should be doing if you're in that function. Simple as that. That's the cultural change we need in organizations.
Okay, Josh, you like to add, or?
Yeah, couldn't agree more. And I mentioned earlier about working for a broker-owned captive manager that theoretically gains me access to present captive techniques appropriately to clients as they're looking at the very early stages of looking at their renewals and their insurance and risk needs. And it shouldn't be a question of just renew the policy, it should be reviewing their risk and insurance needs, put it that way, right? And I actually, I spent most of the last 10 years running a broking shop, and I formed more captives, or was involved in forming more captives when I was running the broking operation than I managed to do now I'm running a captive operation, because I was in the process early enough to see where the opportunities lay to improve the the client program with a captive technique. But it's a constant battle to get it up there, up front and foremost in the mind of risk managers, advisors, brokers, so that they can present it early enough and in the right way to the decision makers in the company.
Okay, thank you, Josh. Ellen, sorry, we have finished up time. If there are, or there is a burning issue or question from the floor before we close the session, is time is up for us, very short. Any burning issues here? Okay, if you don't have, left for me to say a very simple word of thanks to our panel speakers. They are practitioners, okay? Practitioners, and you can rely on them. What they say is really they being practiced. So if you have any question later, it's a cheap advertisement, but I don't earn any commission from them. You can approach them to that. The normal traditional round of applause for them. Thank you very much.